Ladies and gentlemen, welcome and thank you for joining the web conference Market Surveillance Committee meeting. Please note that all participant lines will be muted until the Q&A portion of the call. We will provide you instructions on how to ask a verbal question at that time. You are welcome to submit written questions during the presentation, and these will be addressed during Q&A. To submit a written question, use the chat panel on the right-hand side of your screen. Choose all panelists from the Send to drop-down menu. If you require technical assistance, please send a note to the event producer. With that, I will turn the call over to Dr. Benjamin Hobbs, Chair of the Market Surveillance Committee. Please go ahead.
Okay. Good morning, everybody. Thanks for coming to the in-person meeting of the Market Surveillance Committee, and those of you who are on the phones, looking forward to the interaction today. We've got a full agenda, 4 very important general topics: intertie deviation settlements, storage as a transmission asset, day-ahead market enhancements, and this morning will be devoted entirely to local market power mitigation enhancements. We'll have a couple presentations, one by Gabe Murtaugh and one by Elliot Nethercutt. But before then, as is traditional, I'll first welcome public comment on any issue. If it turns out if it's one of the 4 issues we're dealing with later, it would be more timely if you deferred the comments to then, if that's possible. If for some reason you can't join us later, then we would welcome the comment now. And then we'll have a decision on some minutes from the previous meeting. So at this point, I'll first see if there's anybody in the room who wants to offer some public comments. No hands are being raised. This is what happens in my classroom, too. There are never any questions. Everybody's too shy. Okay, so operator, can you see if there's anybody on the phone lines who has a comment or question? And I understand we now have the capability to take written comments and questions, so if there are any of those, I appreciate being alerted. So if operator, if you could check.
Pressing pound 2 will indicate you wish to ask a verbal question. To submit a written question, please go ahead and use the chat panel on the right-hand side of your screen. Choose all panelists from the Send to drop-down menu. Once again, if you wish to ask a verbal question, please press pound 2 on your telephone keypad. Okay, we do not have any questions at this time.
Okay, thank you. All right, well then we'll turn to the next item on the agenda, which is the approval of the minutes from the September 28th, 2018 meeting here in Folsom of the MSC. Oh, by the way, I should have introduced the rest of the MSC to you. Dr. Scott Harvey and Jim Bushnell are joining me, and I'm Ben Hobbs. So at this point, I would entertain a motion, if there is one, to approve the minutes. So Dr. Harvey has moved to approve. Second. And Dr. Bushnell, second. Any discussion? Nope. Hearing none. I'll then take a vote. Scott?
Yes.
Jim?
Yes.
And I vote yes. So the minutes have been approved unanimously. So now we can proceed. Gabe Murtaugh from the ISO is going to be making a presentation on local market power mitigation enhancements. So Gabe, the floor is yours.
Thank you. Yeah, I appreciate it. Okay, yeah, as you mentioned, the policy team has been working on local market power mitigation enhancements. This initiative that's been going for a while now, and we're in the revised straw proposal phase. This initiative has 3 specific items that are included within scope, and those include flow reversal, economic displacement, and mitigated bids that are below estimated marginal opportunity costs, specifically for hydro resources. You can see on this slide we're sort of addressing those 3 within the initiative, and we've got sort of plans outlined to work with all 3 of those. Today we're going to be talking about the economic displacement, and that's going to be Elliot's presentation, and I'm going to talk about the default energy bid option that we've come up with in response to that third box on the bottom there. So we'll jump into the hydro default energy bid. So as we've discussed in prior MSCs and also in our public phone calls on this topic, hydro systems can be very complex, and a relatively simple equation that perhaps the ISO comes up with may not be sufficient to model specifically what an opportunity cost is for specific hydro resources. We also know that opportunity costs for hydro resources can change day to day, and they can even change within a day depending on hydro system conditions and particular specific requirements that are imposed on hydro resources. So, as we've said, a simple equation and perhaps some of the equations that the ISO may be using today to capture these opportunity costs may not be entirely accurate. So we're thinking about this a little bit more broadly and seeing if we can come up with a situation or a solution that may encompass a little bit more of those opportunity costs for hydro systems in a general fashion. So what we have today and what we're presenting in the third bullet there is a default energy bid that will be available for hydro systems, any hydro system with storage in not only the EIM markets but also in the ISO markets. The idea here is that we're going to try to come up with a transparent methodology that's available for all hydro resources, so there won't be any ambiguity. And then as I've sort of already indicated and as we've talked about previously, this specific methodology for a default energy bid would hopefully be sufficient to meet the needs for a good amount of hydro resources that are currently on the California ISO and EIM system, but we're not making any claims about it being sufficient to meet all of the opportunity costs during all intervals. And indeed, it might be the case that a specific hydro resource could have a particularly high opportunity cost during some times of the year, and during those times it might not be appropriate to use, for that resource, to use this default energy bid methodology, and they may need to use a negotiated default energy bid or an opportunity cost-based adder for their default energy bids in order for their DEBs to reflect or more closely reflect their opportunity costs. So, looking at the methodology that we've come up with and outlined here for the proposed default energy bid, which of course we've been tinkering with and has changed from version to version of this proposal, we're currently looking at something that is a maximization of a gas floor, a day-ahead index, a balance-of-month index, and then additional monthly indices corresponding to how long a resource has storage availability. So and there is a typo on this slide in the first bullet. This should be a duration of up to 3 months rather than 1 month. So if you have a hydro resource that does have some storage availability, it would be eligible for a default energy bid of the maximization of the gas floor, the day-ahead index, the balance-month index, and the month-ahead indice for the following month. And then if you had a resource that had 3 months of storage, it would be eligible for the same default energy bid, but included in that default in the maximization would be the month-ahead index for 2 months in the future and 3 months in the future, because that's how much storage that they have available. And then after the maximization is applied, we also apply a 1.35 or a 135% scalar on that term. And then we've just kind of outlined what each of those terms in the equation is down below. So the gas floor is, currently we've been thinking about this, and that's the gas heat rate for a typical combined cycle resource times the GPI. We've also been sort of playing with the idea of perhaps changing this, maybe looking at a combustion turbine, a typical combustion turbine heat rate, and multiplying that times the GPI, and perhaps not applying the 135%, perhaps applying a 110% scalar to that factor. But that is one of the things that we've sort of been looking at. and we'd love to get the MSC's feedback on that.
So, Gabe, I guess the best place to talk about that is when we start seeing those tables and those percentages later.
Yeah.
Okay.
Which I think is at the end. So we'll go through all the slides, and then we can open up the discussion. And then we've got the day-ahead index, balance of month index, and month-ahead indices, and those are futures prices at trading hubs, and we've outlined those in a few more slides. But those are fairly standard bilateral trading hubs that we're looking at. And we also have the definition there for the gas heat rate and the GPI, which we're planning to use for the specification of the hydro resource that this step would be applicable for. So if you have a resource with a storage duration beyond 3 months, the maximization would be, or the default energy bid would be calculated as the maximization of the short-term default energy bid, which is the formula that we had on the prior page. So all those terms would still be included, including the 135% scalar, and then you'd also have that maximization compared with additional month-ahead indices. So if you had 4 months of storage, you'd receive the short-term DEB, and you'd receive an additional month-ahead index for 4 months in advance. If you had 12 months of storage or more, you'd get the short-term default energy bid, or the max of the short-term default energy bid, and month-ahead indices for 4 months in advance, 5 months in advance, all the way out to 12 months in advance. And then we have a 110% scalar applied to these month-ahead indices. Resources, so there's two things that are sort of implied by this default energy bid calculation. The first one is that resources would have to specify maximum storage duration, and this would be done through a consultation process with the ISO. Currently, the way we're thinking about the maximum storage horizon would be something akin to how frequently we see these resources cycling water. So we've got very large hydro projects that may cycle through water only once per year. So they have, in the spring months, we see a lot of inflows into reservoirs. However, those reservoirs don't reach their maximum necessarily, and they don't necessarily have to spill. And then throughout the summer, they draw down on those resources, but they might not ever draw down all the way to depleting the reservoir completely. And those kinds of resources may have 12 months or more worth of storage, so they would be eligible for all of the components of the default energy bid. And you might be able to think of a different resource that had situations in the springtime when they necessarily had to spill or they had to run, so they're basically price takers during some of the months. But then again, they draw down their storage supplies over the course of the rest of the year, and that might be a storage facility that has something like 6, 7, or not even 9 months of storage, something like that, but something less than 12 because they do have that period where they're spilling. And then you can also imagine resources with shorter-term durations where they're cycling water on a daily basis or a weekly basis. We would consider those to have relatively short durations and would be eligible for a 1 month supply worth of storage and just the 1 month of default bids.
Yeah. So I have a very technical question to this. This sort of calculation assumes that a unit of water, a cubic meter of water now produces so much power, energy now, and would produce the same amount later on. But I imagine that some of these facilities, maybe a very small number, but some of these facilities have significant head changes. So if at the end of the season the reservoir is half empty, that is, the head is half as much, then the same unit of water only actually produces half the megawatt hours. Are head changes significant on any of the large resources that one might be concerned about, or are the head variations really up here rather than like this across the season?
I don't have the answer to that question, Ben. I know you've talked about hydro resources before, so you may know better than me.
Yeah.
You have a list of questions.
That would have to be facility specific and so forth, but if the opportunity cost is some megawatt hour late in the season and the reservoir is drawn way down, then there might, arguably be a need for some sort of correction on the monthly indices. But I don't know whether I'm not familiar with facilities, so I don't know whether, if the correction is just 10 or 20%, then don't worry about it. But if you're losing half the head, then conceivably there might be a difference.
Yeah, and I would argue too, just with this framework, we're really trying to come up with something that would be applicable to a number of resources.
Exactly.
And it's not something, as sophisticated as, hey, we're going to say for one specific resource, here's your nuance and here's your nuance. Yeah. Sorry, Jim.
Oh, I was just going to, I didn't know the right time to introduce this, but seems like Ben brought it up. So, and we've had this discussion that when we write our models of hydro, generally one of the things that's an important variable is the amount of water or energy in the reservoir level at a given moment in time. And that as that reservoir level moves up and down, not just the current, productivity of the dam can change, but also we think of the opportunity cost in a probabilistic sense as kind of moving. If the reservoir is very low, then the likelihood of having water, even though you may have the storage capability for a year, the likelihood of being able to stretch it out for a year is lower than if the dam's very high. And I guess it struck me that reservoir levels aren't part of this calculation. I'm not sure how straightforward it would be to introduce them, but I think I'd be interested to hear. I suspect we'll hear from PowerX on a bunch of things here, and maybe they know about the head height thing. But I'm also curious what the thinking was about how reservoir levels. Whether maybe it doesn't matter on the types of resources in the Pacific Northwest that have extremely long storage capabilities.
So this illustrates this is an illustration of the complexity of it and why we might not want to go there. So it's actually not just you withdrawing a meter cube now doesn't just in fact precludes using that water later. It's not just the impact then, but if you take that meter cube now, you've actually incrementally lowered the head for the entire period of time until that water was finally used. So there's actually an impact on revenues all the way along. So it's a very complicated calculation. I'm not suggesting that we do something like that, but it would be interesting to hear from, if there's some expertise among somebody listening on the phone about how important relationships such as what Jim and I were just talking about might be. But it's definitely not precisely a megawatt hour for megawatt hour type of opportunity cost, at least for some reservoirs. But maybe it's within 10%, so it doesn't matter.
Yeah, and I guess it's important to try to get a sense of how this is not a precise measure at all. We're trying to sort of come up with a way to bound in some reasonable level bidding from hydro resources. And I guess it's worth sort of thinking about whether we're setting this sort of with a lot of flexibility in the upward level, or whether there's a lot of scenarios in which we might still be mitigating below some sense of what marginal cost might be.
I think this is a similar thing that's been bothering me, but if you think about how full it is, if you have a resource that'll store 3 months worth of stuff, if it's full, within 3 months, it's not going to be, it's probably going to be running at that peak period anyway, and what you should be looking at is somewhat lower price. If it's empty, then that may be the right price. So it does seem to be a little more complicated than just looking out and saying, oh yeah, that's the best price we can get over the next 3 months or 6 months or whatever.
I think you're absolutely right, and some of the tables that Gabe will be showing a little bit later shows the impact of basically the capacity factor that you play with as a variable, and this is a proxy for whether you're marginal on just for a few peak hours or you're pretty full. So it does make a difference.
Brad Cooper, ISO. I just add, I think you alluded to, Ben or Jim, the point of this DEB is to not try and model things exactly, because people have made the point that, PowerX has said it well. I won't repeat it all. There's various considerations that even if you have an elaborate model on any particular day, there's enough of variation and all those other things that a reasonable opportunity cost is a fairly subjective assessment. And so, we're not trying to model things precisely and calculate an exact opportunity cost. So I agree with you. If you're calculating an exact opportunity cost, the amount of water they have absolutely matters. But then if you're doing that, though, you're also modeling projected 15-minute prices and, modeling prices very exactly. So, we're just basing prices on, for example, the long-term part, the month-ahead index, which is just a monthly average price. And, if that month-ahead index price if that was the same price in every hour, then yeah, you'd probably want to say, okay, yeah, this resource has 2 months worth of water, so its opportunity cost wouldn't actually be the opportunity cost. It wouldn't be the maximum month. It would be the second highest month's cost, right? But we're recognizing that we can't model the limitations exactly, and we're recognizing that these monthly index prices aren't representative of the actual hourly prices that there's their opportunity cost. So this is more of I hate to say the term, more of a rule of thumb. Is like I think Jim said, a reasonable bound for hydro that reflects opportunity costs, but it admittedly isn't an exact model of opportunity costs. But it's not an exact model of opportunity costs, because then if we get into that, we get into second guessing hydro operations throughout the West that the ISO isn't in the position to do.
I don't follow that, because if you aren't accounting for the amount of water in, aren't you second guessing them when you put in a price that's lower? I don't see how I don't follow the logic there. It seems once you start putting in the DEB, you're second guessing them anytime you're mitigating them.
Well, yes, yeah. I mean, that's kind of the quandary we're in. We can't, we got to come up with it. We've acknowledged we can't second guess them, and so we have to come up with a DEB. So this DEB, I think we're getting agreement that generally that reflects the actual opportunity costs. But you're right. There are instances where it might not be right, and it might be. And it might be too low, and in that case, maybe then people do want to then they do need to get a negotiated opportunity cost.
Well, yeah, and I guess on that, the question I think is whether absolutely I agree with the spirit of trying to not optimize the entire hydro system of the West, I guess, but are the assumptions that you're making likely to err on the high side or the low side, I guess, in terms of a DEB, and under what conditions might they err on one side or the other? And I think that part of that answer has to do with the index you're using and whether it's a peak price versus sort of some average and those sorts of things that I think we will talk through a bit. But
I'd say we're trying to come up with something that either errs on the high or the low side. That's a reasonable approximation, but admittedly may err on either side. But we can look at the data and people can say what they think.
Okay, we do have one question on the phone, and as a reminder, please remember to state your name and affiliation when you're asking a question. Noreen, can you put the call or the question through, please?
Caller, please go ahead. The line is now unmuted.
Hi, it's Mark Holman with PowerX. Good morning. A couple thoughts. One was on the question of kind of head gains and losses. I think just generally speaking, we could see in the 10 to 20% range. I think one thing to remember is that when you're going from, say, a max elevation where you're near spill to a min elevation, min elevations are still not draining the reservoir dry. There's still significant amounts of water in there. And so the 10 or 20%, is not a large amount of noise from our perspective, given all the noise and all the other data elements, I think, as kind of Brad described, in terms of, we're only using geographic hub prices, not 60 or 80 different locations. We're only using monthly index prices, which represent deliveries for all on-peak hours in the entire month. And so I think Brad described it well, that I think this is going a long way, this framework towards trying to get a default energy bid that incorporates a lot of the considerations that go into opportunity cost in a logical and rational way, but also recognizing that you're going to be wrong, so how do we get it to a level that we can sufficiently protect against the risk of the exercise of local market power, while also limiting the risk of second-guessing and inefficiently depleting water and changing the operation of hydro resources. And I think this approach, including the analysis that Gabe and Brad and others have done, is trying to strike that balance. And, as we continue to move forward in the stakeholder process, we're getting increasingly confident that this could end up being quite a good DEB, better than what we've seen even elsewhere, even in the East, in terms of you have a higher DEB when your opportunity costs are higher, and you have a lower DEB when your opportunity costs are lower. It's not right in any given hour, but if we can get it to the level where the risk of getting it wrong is relatively rare, because getting it wrong and depleting water at the wrong time can have some very serious consequences if that happens many hours in a row or multiple days in a row, while also providing very substantial protection against local market power. Last point I would just make is in terms of the comment about, not knowing the exact reservoir level at that point in time. I think the thing to remember is that these hydro systems have so many factors that have so many different values for parameters. For example, it's not just where the reservoir level's at, it's what are the different inflow sequences you might experience over the next 6 months. You may have, 40 or 60 or 80 different inflow sequences that you want to consider, not only in terms of the amount of water, but the timing of water, the different sequences for load that needs to be served first, the different sequences for discharge restrictions. So I really caution against trying to be too refined and too specific on any one element, recognizing that this is not attempting to model hydro opportunity costs, but it's trying to get a good proxy for what a value might be in the right range, balancing the need to protect against local market power, while also ensuring that hydro operators maintain their autonomy to efficiently manage the hydro systems.
Thank you, Mark. Just as a general comment, that we all realize that this is extremely difficult. We in the U.S. system of ex-ante market power mitigation that was designed originally for thermal resources, it's a very difficult fit with hydro resources that have the stochasticity and the complexities of interactions and so forth. But if we insist on, if market power is an issue, then we should do something, and this raises the general issue of what can be done. Setting DEBs in general on a level that's perhaps a little bit generous on the high side, that could perhaps be justified because using up water prematurely during tight system conditions might be a worse outcome than suffering some market power. That's something that could be debated. I mean, the alternatives to this are either negotiation, and that wouldn't necessarily result in a better outcome, and it would be less transparent. We're not going to go the Brazilian way, which is everybody has to bid their opportunity cost, essentially, and the government runs a huge hydro model with all the multiple sequences and so forth. We're not going to do anything like that. The only other possibilities are moving away from the type of market power mitigation system that we have now, to either dealing with structural market power by industry restructuring regions, and that's not something that is going to be contemplated certainly as part of EIM, or ex post monitoring after the fact. This is what is done in Europe, and trying to identify when market power has been exercised and threatening fines and so forth after the fact. That is, of course, a very difficult thing to have happen, and it's, if it's locking the barn door after all the animals have gotten out, may not have done very much. So we're stuck. This is just a statement that we're, this is a different thing. It's no really satisfactory way. One thing I would ask, if we're going to if it's possible to do some more analysis, it would be interesting once we're sort of in the ballpark in terms of what kind of formula is going to be used, it'd be whether it would be possible to go back and say, well, how have bids offers compared to these DEBs in the past? Is this something that would frequently have been binding and changed offers in the past under certain conditions? And I recognize that would be a lot of work. If it turns out that there's so much headroom here that it would never have made a difference in the past, then whether the number is 1.1 or 1.35 perhaps doesn't matter. We just know it's not going to be binding, which may be because a lot of these utilities are vertically integrated in a sense, and or there are plenty of reasons to bid competitively, or this may imply there's really not much we can do about possible market power in hydro, and we just have to live with that. But that would be an interesting thing to know, whether this formula for longer duration resources or the 1 for 3 month resources, is that something that would have actually bitten at times in the past or not? And I don't know if anybody has a sense of that. So I guess that's a focus question at the very end, Gabe, which is, do we have any sense at all how this compares to offers that we've seen historically?
Yeah, that is a good question, and it is relatively complex, and we have not done any kind of analysis on that to date, but I think it's a question that probably warrants looking into, at least for some resources.
Yeah, okay. I think that would be really very helpful to know whether it would have made any difference at all in the past, or it's just so much headroom compared to the offers we see. We can either be assured the markets are workably competitive, or the other conclusion is maybe not.
And I think one of the questions that PowerX generally raises is that, well, if you have something, or if you see a resource bidding perhaps 10% of the time or 15% of the time above what these DEBs are the DEBs potentially too low because during those 15% of intervals you might be getting inefficient dispatch. So that threshold is interesting, but you're right. If it's 1% of the time, maybe these are too high. So we can sort of think about those numbers some and maybe get something back to the MSC on that.
So more generally, this is DMM's problem. We've had a classic tool of market monitoring has been to run the market, competitively, see what happens and compare the outcomes in that simulation to what actually happened. Doing this for a hydro system is much more difficult. And Gabe, as you hint, what if you did see that 10% of the time people were bidding above this and it was affecting market prices? Is that ascribing that to market power versus we just don't understand the opportunity cost? We can't actually tell the difference. Right. But I still think it would be useful to know whether it might be 10% or might be more like 0.1% or something else.
Sure. Yeah. Okay, thank you. And the other thing that struck me while we were having that conversation was that the ISO does offer the opportunity cost adders for specific resources, and those do encompass future prices and a price duration curve and a known amount of storage and water availability in a model to come up with default energy bids. And our thinking was that in particularly dry months or stressed periods for these resources, if this default energy bid doesn't work, perhaps an adder would be appropriate there for opportunity costs. Okay. So, and I did just want to make the final point that this is similar to other existing default energy bids. You know, it would be something that a resource owner could go into the master file and select as an option for their hydro resource with storage, obviously with the caveat that, that these maximum storage horizons would have to be determined and consulted with the ISO before these could be put in place. And these would be, as other default energy bids are, these would be calculated on a daily basis. So the ISO would go out, they would pull all the numbers for the future indices, they would pull the gas price indices, they would pull your local calculation for gas resource, and then do all the math on a daily basis, and that would be the DEB that the resource would be subject to on a day-to-day basis. So as we mentioned, there's two customizable inputs to this formulation. One of them is the maximum storage horizon, which I think we've sort of already gone over. The other is the long-term bilateral hubs. So for simplicity, we've outlined these in the papers. I haven't spent a whole lot of time on them in this presentation, but we've narrowed these down from sort of the universe of bilateral hubs that may be traded out there to Palo Verde, Mid-Columbia, NP15, and SP15. So we just have 4 that we're considering here, and we think those are relatively representative of the regions. And again, Brad sort of alluded to this as well. You know, with these, I think we can use them to sort of use them as a prediction on what's going to happen to prices within the EIM areas, and then with the adder we can sort of capture some of the volatility in the 15-minute markets versus these bilateral hub prices, and we are using peak prices for the hubs, you know, which are averages over, which could be multiple hours per day or monthly averages or something like that.
So, Gabe, this is Ben. On the maximum storage horizon, is that something you imagine would be dynamic in the sense that, you know, one time of the year it might be different than another time if we've got a reservoir that's cycling kind of on a yearly basis? So as you get to the point where the reservoir, you know, just before the spring freshet when it's going to get filled up, we would have a shorter time horizon. Because if it's February, August prices don't matter, even if you have a lot of storage. But after the spring freshet, once it's June, then 12 months of prices matter because you're going to be slowly drawing it down for the next 9 months. So, the owner would be changing this and justifying this. You can imagine that happening?
Yeah, we see the maximum storage horizon as a relatively static figure that doesn't change from year to year, so it really is a maximum of the amount of time that you can store or cycle water through your facility, and we think, you know, bound it below by 1 and bound it above by 12. But for the most part, these don't change very much. And we certainly have thought about, well, you know, exactly like you say, in the spring months, you really aren't able to, you know, ration out your water over the next 12 months. Maybe you're really only looking over the next month or two, so you're more effectively a price taker during those periods. But we think that this model may work, and during those periods, we're not you know, when resources are running, we're not particularly, we may be less concerned with market power, and that may be another reason that this would be acceptable.
Okay, so let's be concrete. Think of, you know, February or so. The reservoir is being drawn down. We're anticipating the melt to start. You know, I don't know when the melt starts in British Columbia. Is winter over by June? Sorry. So anyway, so February, it might be a couple months before you have to start inflows and start filling it up. So August prices are, if you're assuming that if the reservoir will fill up, then August prices are relevant. It's really a 3-month resource approximately at that time. But once the reservoir is filled up and now the inflows are going down and if you're not spilling anymore, then 12 months might be relevant for a very large reservoir. So I could see a rationale for switching between, you know, 3 and 12 months, depending on the time of year, how far off you are from where, you know, the system gets reset because you're filling and spilling. And of course, that will depend on the water year. If it's been a very dry year, you may not be filling, or if you do fill, you may not be spilling. You may be using all of it, in which case a longer horizon may be relevant for February in a dry year where it's not relevant in a wet year. And maybe this is, getting into the territory of, finessing things, as Mark and Brad were saying. There are a lot of approximations, and it's, is this an approximation? But I really do have a hard time seeing how potential August future prices are relevant to a reservoir in February that if we're pretty sure it's going to be refilled and spilling before then. But certainly 9 or 12 month out prices are relevant once the freshet is over and you've quit spilling. And so I don't know if this would be in the form of some guidance, whether DMM would want to take a look at some of these sorts of issues and glance at what reservoirs are stating and perhaps identify conditions under which the time horizon we should basically go to the 3-month rather than the 12-month one. Not sure how that would actually be implemented, but I think it's something that should be considered if my characterization of what is happening, at least with some of these big reservoirs, is accurate.
Stephen?
Yeah, can I just ask a question? In terms of determining what the storage is in a reservoir, what assumptions are you making about how many hours a day that it produces energy? Because, it seemed to me that there's a difference between how much you can store if you're running 24/7 versus if you're running 3 hours a day on weekdays.
Yeah, we don't, and that's the thing with this formulation. We're not making any assumptions about how frequently a resource is running. With some of the analysis that we've done, we've sort of taken the stance of, okay, let's suppose a resource on a specific day, has the ability to generate, during 10% of the intervals, but they don't have any water outside of that 10% of intervals. And let's see, given historical prices, how frequently this default energy bid would dispatch them more than that 10%. And that's sort of the analysis we've been thinking of. And again, this is more of a construct where this formula would be something where we would hope that the number, would be sufficiently high so that the resource wasn't mitigated and we didn't have the adverse consequences of drawing down a reservoir inefficiently. But then it also, the formulation isn't so high that, we're setting, sort of a bar that's above any reasonable opportunity cost for any resource point.
Okay, I get that. My question, I think, was more basic, though, and this is just my not having spent a lot of time working with hydro resources and not understanding. When a hydro resource says it has 3 months of storage, is that, how do they calculate that number? What's the assumption about, how much they're running over that period?
Mm-hmm. Yeah, and I think there wouldn't be any assumptions about how frequently they're running. It would be an assumption about how frequently we see them, from a historical data perspective, how frequently we see them cycling water through their facility. So if we see them moving from a relatively low amount of water to a relatively high amount of water once every 3 months, that would be our justification for using the 3 months for a maximum storage horizon here.
Okay.
Yeah. Yeah, let's go ahead.
It seems to me that there's a couple other things to think about in looking at this. Ben talked about in the spring period where the water's running in, this number might be too high, but what's the potential for the exercise of market power in the spring when Mid-Columbia prices are 15 cents or negative, and is that what we need to worry about? And if this is setting a number that's like $35, is that sort of okay over the year that isn't going to allow any material exercise of market power? That it's capping people from offering power at very high prices where they have local market power, and it's sort of a price which sort of is the general price of hydro in the West, and people would be holding it back if it were materially lower than that, and they could. We're not really trying to drive the price down during the summer, the spring runoff period. If there's plenty of competition during that period anyway, that we don't really need to worry about that unless we actually see something that happens that for some reason we think there's something bad happening during the runoff period. But I think it'd be the other way around. The prices are so low. Another thought about this is that it's a little bit different, but if we're thinking about the EIM entities, this is supposed to be the price of the power they offer for flexibility, right? So they really shouldn't be offering power to provide flexible ramp if it's something that's, they've only got, 40 megawatts of power they can release all year out of this reservoir because it's hardly got any inflow and they need to save it for the absolute peak. Well, they shouldn't really be offering that in the market. So to provide flexibility, because it's that scarce, they should only be offering it maybe on that one peak day when we're likely to use it. So maybe it doesn't really matter that we're not going to catch the absolute peaks of prices if the EIM entities aren't going to really be offering that reservoir for supply in the EIM anyway. But that might not work for the California utilities who've got water because they're offering everything. So I can see a possibility that we need a more nuanced approach for the hydro resources in California, where maybe they're offering everything and they do have particular resources with high opportunity cost, but maybe that's already being taken care of with the negotiated default energy bids we've got today. I don't know.
Scott, along the lines of your first point, I know Eric Hildebrandt from DMM made some comments along those lines specifically about, hey, in the springtime we might be okay with having something like a $30 floor on default energy bids because for hydro resources, because we know hydro resources aren't necessarily exercising market power during some of those spring high runoff months. And I think that's a valid point. They're trying to manage their systems and get whatever price they can during those periods.
Okay. So I've heard Gabe, you and Scott, and indirectly Eric say that the period that I was, the hypothetical example I was concerned with right before the freshet, that you shouldn't be looking at 12 months, but that's a time that generally prices, at least in Mid-Columbia and up there, are very low anyway, and so it's relatively competitive conditions. So I can see that as mitigating it. So I guess the danger is conceivably more in the summer or perhaps later in the fall, where you might still have high demands and high prices, but now water definitely has a scarcity value.
Well, I agree with all this, but I guess the example you originally came out with was more of an issue of not necessarily during the spring runoff, but before the spring runoff. Right. So, and so January, February, and we don't usually think of those as crisis periods either, but it's a little different than the spring runoff.
Yeah, that is historically when prices have been higher in the Northwest. The problems in the Puget Sound area are in the winter, or have been in the winter before the Amazon days. Now maybe people can afford air conditioning, but so I guess that's an empirical question. It would be interesting to have something, some information about what prices have looked like in the winter up there. If there really is an assessment that there's really no chance for market power these days up there in the winter. So let's not bother trying to be more dynamic in terms of the amount of storage.
I don't think that's what we're saying, though. I don't think we're saying not mitigate it. We're just saying that you don't need to worry about depressing the price from $30 down to $15 because in that period, because the water is going to start flowing in. We're still going to say you can't jack it up to 180, but we're just saying that a general level of hydro that's around $30 that you're setting based on looking out might be okay in those periods, and that you don't need to optimize it to try to figure out, okay, well, actually it's going to be driven down to $12 in a couple of months, so we're going to need to put the cap down at $18 based on the fact that it's going to they're going to have to start releasing it pretty soon.
I guess my concern was more than, what if the futures were 150 for August? And that's really not relevant for a reservoir in February if it's going to refill. But then they're not going to bid 100. They're probably not going to. I thought what I heard you say was that, it's very unlikely that they would be bidding above 30 or anything else in the winter anyway. So it's finessing.
Prices are, but I understood that maybe we're getting prices in the $35 range, and if that's formula is yielding, then that doesn't sound like a regular market power to me. But if it's yielding 250, then that would be, different. I mean, it's hard to speak in a complete vacuum here, but.
Yeah, and I think some of those periods like you were thinking about, and Stephen, we'll get to you in just a second, but some of those periods where we're in January and maybe we're looking out 12 months, like we're saying, we typically see prices for August generally being the highest for these month-ahead indices, and we might see them in, for mid-Columbia, maybe in the $50 to $60 range, and then that's another one of the reasons why we only have the 10% adder on those monthly futures prices that are further out. So, I think you could conceive that, a resource with 12 months of storage, so one that's not going to be spilling in the spring, maybe does have a trade-off between, running in January and then running during those peak summer months when they could potentially get a little bit more revenue. And maybe that $60 or $60 plus the 10% adder wouldn't be so appropriate. Give a little perspective. Stephen, you had a question?
Yeah, I just want to say, I think then you have to be careful. You're saying this idea that maybe we don't need to worry about this because there's lots of hydro resources and lots of stuff. Remember what these are used for is when the LMP, local market power mitigation test has failed. So you're in an area where these guys do have local market power. So the fact that the rest of the market has a ton of hydro resources and prices may be really depressed, I'm not sure that actually matters at this, for the discussion we're having here or for how these resources are used.
Yeah, that's a good point. You could still, in the Puget Sound area, because of limited transmission capability of the area, you could have some local problems there, even if there's a ton of water in British Columbia.
Okay, do we have a question on the phone, Chammy? Yeah, why don't we take that right now? Operator, go ahead.
Caller, please go ahead. The line is now unmuted.
Hi, it's Mark Holman with PowerX. A good discussion. And I think I understand the point about the February and if you're going to spill in the spring. Just a few comments on that. First, some of these resources that are participating in the EIM have very large reservoirs. BC Hydro's largest reservoirs, which provide underlying facilities for participating resources, typically don't spill at all. They will spill on a relatively rare year. They can go year after year without spilling. So one thing to remember is you're capping it at 12 months, and you may be looking at opportunity costs 2 or 3 years out in time. And again, it's a matter of not trying to be too precise on any one element. And so the second point would be is that it's generally not a matter when you have longer-term resources, even some of what I call the mid-term storage resources, that you're going to spill come spring in February. You've got numerous different parameters that are driving different probabilities of spill. You've got different inflow sequences, different load sequences, generation outages, and so you're trying to estimate probability of spill. And if you're on a longer-term storage resource and your probability of spill, because your reservoir is relatively high and it looks like you're going to have high inflows, is 80 or 90 or 100%, it provides a high level of mitigation, because if you don't price your energy competitively and move the water out as fast as you can, you're going to be causing spill by not offering supply at a price that you get dispatched consistently. And so there is a self-correcting measure. I get the concept of perhaps for some others resources who typically spill in the spring, shortening that time horizon, but I really question as to whether that's beneficial to try to go through that exercise, given that there is no right answer. It's going to be some probability of spill. It's going to be subjective. It's going to include numerous different factors to try to determine that. And when it matters that you are likely to spill, you've got a very strong incentive in that February, March, April period to be generating your power and getting the power pushed out. The other point I would just make is that, to recognize again that the EIM is a voluntary market, and we know from experience and what we've heard from other Northwest Hydro operators that if we begin to come up with an LMPM and DEB framework that ends up with what we're seeing from the current proposal is prices that are most typically, with exceptions on high price periods of $40, $50, $60. If we come up with a framework that says, no, we don't think it's 40, we think it's 28, and it starts interfering with hydro operations 5, 6, 7, 8% of the time, all that's going to do is discourage those hydro resources from being in the market in the first place, because it's not just about efficient water use. Depleting water 2-3 days in a row in the wrong hours can lead to fish considerations, violations of a variety of constraints, and it really results in the entity looking and saying, not only is the EIM not working from a hydro operations perspective, there's other opportunities out there to monetize your resource and your surplus capability, and there's actually a much easier way to do it, which is to just look and say, look, I'm just going to sell into the various markets in the hours that I think are better priced, maybe even as a price taker as a self-schedule, and not participate in the other hours, and you'll be far better off optimizing your resource by trying to pick the good hours as opposed to providing the CAISO as market operator with flexibility. And so you end up chasing the flexibility away. As Dr. Harvey said, when you're talking about default energy bids that are most typically, from what we're seeing, in the $40, $50, $60 range, other than during tight conditions, what are we trying to achieve here by trying to get that next level of specificity, and at what cost? And even the entities who are buying that power will not be better off if the hydro resources are not encouraged to participate in the market.
And actually, all that would be very reassuring if the other market opportunities, if those markets are workably competitive, then we could be pretty sure that what would be offered would be competitive bids. So, so thank you for your point, Mark, emphasizing that this is a voluntary market and this is being used for flexibility. And I think I also heard you say that the consequences of too low a DEB, there's an asymmetric risk of too low a DEB and overproducing at the wrong time, that the consequences of that could be more severe than too high a DEB. Any other comments at this point? Anybody else on the phone, operator?
We do not have any other questions right now.
Thank you.
Okay. So we talked a little bit about the maximum storage horizon, and we talked about the bilateral hubs. So for the long-term components of the default energy bid, so those month-ahead indices for 4 months in advance, 5 months in advance, all the way out to 12 months in advance, we would have the ability for resource owners to specify that they had long-term transmission rights to actually move energy to one of these other hubs if they want it included in their default energy bid. So, for example, if you were a EIM resource in the Northwest, and this is outlined in the paper too, but if you were a resource in the Northwest EIM, you'd be eligible automatically for the long-term month-ahead indices for Mid-Columbia, and if you had the storage capability, the storage horizon. But if you wanted to say include Palo Verde bilateral hub prices, you'd need to demonstrate that you had long-term transmission rights to Palo Verde, and then we would need to see those, and theoretically that would have to be demonstrated on an annual basis, as those rights are generally bought and sold on an annual basis. If, however, they were sold or traded, we would ask that any of those rights ownership changes would be reported to the ISO so that we could update our calculations accordingly. So this next slide sort of gets into our analysis. So we're moving into actually applying this calculation and seeing sort of what the results are and comparing that to current market prices. What we've done is we've taken data from October 2017 through September 2018. So we've got a year of a relatively recent history And we've sort of done this hypothetical analysis for a particular resource that would be located in the Northwest in the EIM. So we've used the Mid-Columbia Bilateral Hub for all the hub prices for the day-ahead, month-ahead, and balance-of-month indices. And then we've used the gas price index with just flat SUMAS prices. And then we've also, and we've done this calculation for each day in between October 2017 to September 2018 for two different resources. One resource that had 1 month worth of storage, and one resource, so you could imagine like a relatively small resource with a little amount of storage capacity, and then a larger resource with 3 months of storage capability. So then what we did after we calculated the default energy bids for each day, we also compared those default energy bids with the real-time FMM prices in the Pacific Corp West balancing area. Of course, we've got data for that entire year worth of time frame for Pacific Corp. And then with those two numbers, we determined when a resource would be dispatched and when a resource wouldn't be dispatched. So if the DEB is higher than the prices in the EIM area, the resource wouldn't be dispatched. If, on the other hand, the DEB was lower, we would consider the resources bidding in at that DEB, and then that bid being accepted and the hydro resource being dispatched. We aggregate, for the two sets of analyses that we did and we're presenting here, we've rolled these up. So we've looked at aggregate dispatch on a daily basis or a weekly basis, and then we've compared those to different thresholds, so 10% threshold, 50% threshold, and I'll go through all that. And then we've compared our estimated dispatch here with those predefined targets. Now, I will say I included an asterisk here under bullet number 2, just because we're not going through and we're not doing any sort of re-optimization of the model. You know, we're not saying, hey, if you know you've changed your bid suddenly, you're not going to re-optimize and come up with a new price. So we haven't done any sort of analysis like that, and we haven't really done the kind of analysis that perhaps Ben is suggesting of, hey, let's compare these to what they've actually bid, and if they bid lower, maybe we don't consider the DEBs. So we haven't taken any of that into consideration either. We've only looked at the DEBs here for this example. So what this shows is a particular resource, and we're saying that, let's suppose it's a resource, and the way we're calculating the default energy bid is for a resource with 1 month of storage capability. And then during that month, let's suppose that on a specific day, the resource has perhaps, yeah.
It's also the same, this should be a 3-month storage?
So the next slide is 3 months. Yep, yep. So for example, you know, suppose,
yeah, I would add though that this is also applicable to the 3-month storage resource to the extent the day-ahead price becomes the binding term in the equation, because even the resources with longer-term storage horizons can have limitations in the day that might be exhausted on a particularly high-priced day.
Okay.
So on the top row there in green, we've sort of got the different delineations between potential availability of water. So if we said we've got a resource that could run perhaps 2.3 hours per day or 10% of the intervals, or 3.5 hours or 4.8 hours, well, what would happen if we changed the scalars that were applied to the formulas? So for that first box, if the scalar was 116%, so we've got, in our maximization term, we've got the max of the gas price floor, we've got the day-ahead index, we've got the balance-of-month index, and just 1 month ahead index. Essentially, the 116% scalar says that a resource that only had, you know, on a specific day, 2.3 hours of storage, it would be dispatched 2.3 hours or less 65% of the time. If, however, you raise that scalar from 116% to 165%, then that resource is, obviously your default energy bids are going up when you do that, but then the resource is dispatched 2.3 hours or less 95% of the time. And sort of 95% of the time, or 1 in 20, was kind of the number that we were using as a baseline for this analysis. And you can see, obviously, if a resource had more hours of available storage, they would be dispatched that amount of storage or less more frequently with the lower scalars. So we also completed the same kind of analysis for a resource that had 3 months of storage, so we've got not just the month-ahead index for the current month, but the month-ahead index for the current month, for 1 month out, 2 months out, and 3 months out. And then we've sort of done a little bit of a different analysis here, and we've said, okay, let's compare that to how much energy you might produce in a week. So again, if you've got 10% availability, or you can produce 16.8 hours in a week, or about 10% of the time, a resource with a 131% scalar is going to be dispatched 16.8 hours per week or less 95% of the time, whereas if you just had a 105% scalar, you'd be dispatched 16.8 hours or less per week 62% of the time. But as Brad mentioned, you might not have weekly energy availability. You might have just daily energy availability, even though you do have 3 months worth of storage. So you could also envision an additional analysis where you looked at the same DEB formulation with a resource that had 3 months of storage, but you might compare that to energy availability on a hours per day instead of an hours per week. So we could do a similar analysis to what we did in the last chart.
One question.
Sure, Scott.
You did this analysis over a year. Is this the average percentages over the year, or is this the highest percentage, or
these are average?
It would have been different every month.
Average percentages per year, yeah.
Okay.
So we looked at every day, and we said, so for the first, it's a little bit easier to think about in the daily storage. So in the first one, we had 365 days, and each day you were either dispatched more than 2.3 hours or less than 2.3 hours. And that's how we came up with and then the overall average.
But it could have been in some weeks we were dispatched more than that 90% of the hours, and in other weeks it was only 10, so it averaged out?
No. Maybe I'm misunderstanding the question, but we're saying on a daily basis we're coming up with, are you running more than 2.3 hours or less than 2.3 hours?
And every day has different prices, so I'm trying to understand, were there some days where you were dispatched too high every hour, and other days where you were dispatched too high hardly at all, and it averaged out to 55%? Or was it never higher than 50% over any day over that entire year? Or
and was a dispatch for like 21 hours treated the same as a dispatch for 5 hours in the 2.3 case?
Yes, they are. If we considered, are you dispatched more than 2.3 hours or not? But the data is the same. The data that we use is the same for each of the columns, so you can sort of get an indication. So if you had an adder or a scalar of 130%, you're dispatched more than 2.3 hours, essentially 19% of the time, but you're never dispatched during that same year. You're never dispatched more than 8 hours per day. 99% of the time, you're 8 hours or less.
But is that true every day, or is that true on average over the year?
So we look at on a daily basis the results, and then we're just displaying the average of those results in this table.
So this is the percentage of days.
Correct.
So if Jim, I think where you're going, if it's highly skewed, if there's some days where you way overuse it, and that's like in the very upper left-hand one, if in the 35% of the days that you overuse it, you're overusing it, you're running it for 5 or 8 hours, then the average use might be way above 10%.
Absolutely.
Even if that's at 50% at the median.
Yep.
Okay.
Yep, that could be true.
So that's another thing.
Right, but the right-hand column, the comment about the right-hand column is informative. So, like at 143%, you're not going to be over 8 hours ever.
Right. That's correct. That's right. You've got the distribution.
But yeah, the chart is nuanced, so it's a little bit challenging to.
I mean, if they have a month's worth of storage, why are we looking at it day by day? Wouldn't it be looking over the month or the week or something that we dispatch them more than the target? Because
yeah, we've heard from a lot of stakeholders on this, and the feedback that we've heard is that some of these storage resources really do have limitations that bind how much energy they have to dispatch on a daily basis.
Okay, but then we should be using a daily standard. This is, I mean, I don't, if it's a monthly standard, and this over, how often do we go over with a month? And if it's a 3-month standard, if it's a daily standard, then we should be looking at it daily.
Well, and that's exactly what this chart does. I think. I hope.
So this is for a unit with a daily limitation, not a 1 month or 3 month.
Yeah, I guess the question is, if it's truly a daily limitation, should we be using a monthly index?
So, yeah. So I think one of the answers is, well, the month-ahead index is sort of the data that we have available. So it's one of those inputs that we have that could be informative as to what's going to happen with potentially prices in the EIM areas. So it can be informative for those prices. But what we've heard from stakeholders is that even with a resource with a 1-month storage horizon, you know, those resources can have energy limitations on a daily basis, and when they do, these are the kinds of things that they're concerned about. You know, they're not concerned, you know, are we run at 10% over the entire month and the 10% of the best hours. They're concerned with, are we run at 10% of hours on a specific day, and if we are dispatched too frequently on that day, that can have the negative impacts for the resource.
Right, so we should be you're looking at a 1 month limit then, a 1 day, not only is 1 and 3 then.
Let me think about that, Scott, for a little bit. Stephen.
Yeah, I want to bring up something. I think, Scott, you brought it up before, that if these resources are being used in EIM they're essentially balancing resources. If they're putting them in for 24 hours a day and they can only run 3 hours a day, I'm not sure that meets, you know, what was expected in EIM. You know, in EIM, you're supposed to put resources in, you're supposed to have resources, flexible resources to meet your own, you know, your own load going up and down. And if you're putting in a resource that can only run 3 hours a day, it seems to me you're not exactly meeting the spirit of what was supposed to be going on in EIM. So maybe, you know, maybe these resources, if they have limits, if they can only run for 2 hours a day, I mean, I would assume that the entity would be, you know, limiting them to probably, you know, where they think they'd get the most money in the first place. They wouldn't be putting them in for 24 hours. So maybe you need to limit this to like the on-peak.
I think you're misinterpreting the EIM requirement. The EIM requirement is to offer in every hour. It doesn't mean your resource needs to be dispatched every hour. It'll be dispatched in the optimal hours.
I understand that, but what I'm saying is, I think if they have a resource that can only run 3 hours a day, if that's the one they're using for all 24, that seems a little fishy. That, you know, it seems to me that might be the one they would use for, you know, maybe the 8 peak hours or something. Well, so what I'm suggesting is maybe this analysis, instead of covering all, you know, 87, 60 hours, you need to cut it down to maybe just, at least for like the 2.3 hour type resource, maybe just the peak hours.
So, Steve, EIM is for deviations from the base schedule, right? So they do balance their area by submitting base schedules, which are currently hourly. So every hour you have balanced your load forecast, and this is additional capacity that you basically make available for deviations to the forecast, deviations to theirs, and flexibility. So that doesn't mean that a resource that has a 3-hour flexibility in the day, it's still used for the entire day to balance the load through the base schedule, which could be different in every hour. So this is additional capacity that is going to be used for additional things, flexibility or...
Right, but the question he's raising is how often does a resource, how much energy does a resource need to have over the day in order to provide that flexibility? How often, I don't know how often they're being dispatched up, but if it couldn't meet the normal dispatch pattern for a flexible resource, then it...
I think if we consider both flexibility up and down, the two come together. So you could actually maintain the water reservoir at the same level at the end of the day and still provide upward and downward flexibility during the day.
If the resource had that ability to be dispatched down, but if this is just a resource that's providing upward flexibility because it's got limited water, then that.
Sorry, Scott, I was referring to having the base schedule as a reference. So you can generate more than your base schedule, so you're deeping on your water reservoir, providing upward flexibility or upward energy, and then you can just go back to your base schedule by letting your inflows come in and store. So there is some capability to provide flexibility throughout the day and still maintain your water reservoir level, right?
But the question she's raising is 2.3 hours enough? I mean, that's providing some, because, you know, but how much flexibility do we typically need from a resource in EIM over the day to?
Well, I guess, well, first of all, I don't even know. This is sort of like an example ISO's cooked up, so I don't know if there are a lot of resources that are actually in this 2.5% range. But also, I guess I'd think of it differently, that if it can provide 2 or 3 hours a day, it could be a really useful 2 or 3 hours a day for the rest of the system. And so do you want them bidding in or not? And I think, I'm not sure if the underlying thought there, Steve, was that they can always just not bid in for the other hours of the day if they're worried about this mitigation being too strict, or that they shouldn't be bidding in at all.
I mean, my thought was just if they have a resource that has 2 or 3 hours of capability, they're, you know, and there's a risk that it's going to get run, I don't think they're going to put it on at midnight or, 3 in the morning. They're going to put it on probably where they think it's going to be most valuable, is when they would be using it as their scheduling resource. It's kind of.
So a resource that has 2 hours availability, they bid it in to pass the resource sufficiency test. We dispatch it or we don't dispatch it. Once we dispatch it and exhaust its availability, they're presumably going to bid in another resource. So I'm just.
I think you're missing the point. The thing, suppose that in order to achieve that, it had to bid in at $900. Would we say that a resource that in order to given its water, its opportunity cost was $900, was providing the appropriate flexibility?
And Scott, I think part of what this table is saying is that, even if you, and we agree, these examples might be a little bit extreme with just 10% of availability, but even if you did have a resource that only had 10% of availability, we only wanted them dispatched 10% of the time, we wouldn't necessarily need a huge number. We wouldn't need $900. We'd only need 165% of, the month ahead index and the day ahead index. So I think we maybe are really getting to that sweet spot of, hey, this is a DEB that's not overly burdensome, it's not overly high, but it still allows for some resources to be dispatched relatively infrequently, so we don't have those negative consequences of, maybe we do have 2.5 hours of water that we can distribute throughout the day, and we're already meeting our base loads in EIM. Well, we can still offer that in, and we'll offer it in at such a price that would allow the resource to be only dispatched during a few select hours of the day, which is sort of beneficial for everybody.
I mean, I think that's the other side of this, that the 110% multiplier is such a small premium. It means that the resource has to be available a lot in order to, it's implying a resource that's dispatched a lot. But if we went to a different formulation, then it would be more important.
Well, and that's sort of what we're trying to get to, and maybe I didn't go through enough of this chart here, but even with a resource or for a resource with 3 months of storage, we're really only dispatching them more than 10% of interval, with the 135% adder on the short-term component, which the long-term components or the long-term resources are eligible for. We're really only dispatching them more than 10% of hours on a weekly basis, like 4% of the time. And yeah, we said, well, maybe some of those times we're dispatching them a lot more, but from the chart here, really it's not happening that often. So the numbers that we have seem to be, or they would seem to be sufficient to not overly dispatch those resources, and they're not hopefully overly burdensome and too high at the same time.
Okay. Hey, Ben.
Okay, and I think we have a comment on the call, so maybe we'll take that.
But I would.
Oh, sorry, Brad.
Suggest so we still have the economic displacement part.
Okay.
Might want to leave some time for that.
I have a quick question after the person, whoever's on the phone lines, and then we'll be done. Operator, is there somebody?
Caller, please go ahead. The line is now unmuted.
Hi, yeah, it's Mark Holman with PowerX. I think maybe it might be helpful if we could just back up to slide 9. It might be able to helpful to provide some insights on how I understand the CAISO's analysis here. Is the 2.3 hours is an example. Let's just say for starting, you have a resource that's currently facing a daily limitation. I think George touched on it. That let's say it's a 500 megawatt resource, and you've base scheduled 250 megawatts to serve your load. Those 2.3 hours are additional water to be inked, but of course it can be decked. So it could be inked 12 hours and decked below 250 10 hours, and the decking is saving water to allow 12 hours instead of 2. And so it really understand that 2.3 hours is if it's only got 10% of the hours available where it can ink, and you end up getting the DEB too low, then what you may end up doing is let's say in hours 7, 8, and 9, they're all positive hours, but hour 9 is the highest price. You might end up depleting its water in hours 7 and 8, and now it's not available to ink. But you can kind of think of it more like batteries, that just because you have a 4-hour battery doesn't mean you can't participate in providing flexibility. You can be charging and discharging all day long. And so it's not that uncommon to see some of the smaller resources in the Mid-C area, for example, to have a low inflow day come about where they've already base scheduled the bulk of their supply, inflows have dropped, and now they're down to 10% of hours for additional water if all they're getting is inked. And if you don't get the number right, you're going to deplete it, like I said, in hours 7 and 8, or you're going to end up depleting it in hours 17 and 18, and then the highest hour in hour 19, you've got no water left because you've depleted it. The second point I would just make is that you may have a 1-month storage resource. What often happens, and when I think of a 1-month storage resource, I think that a sale today might displace production up to a month out in time. But what you can often find happening is that if you get into a high price day and you're selling really hard, you start to hit other binding constraints. For example, you have a 1-month resource with 1 month's worth of storage, but if you generate really hard all day long, you end up creating so much discharge that you flood the facility downstream that has smaller storage, so you're now against a binding daily storage limit because you've been generating so hard on that day that you can't generate any more water across that day, even though on most days you can trade off selling 4 or 5 or 6 hours today versus next week or the week after during that one-month storage horizon. So the storage horizons really do change, and that's why I think the CAISO here has come up with examining a 1-month resource that's facing a daily limitation, and maybe it has low inflows above its base schedule on this day. And then the next slide says, well, what if you had a 1-month resource that was facing a weekly limitation? How often might you deplete its water early? And it doesn't really matter whether it's, if you have 10% in 2.3 hours, it doesn't really matter whether it's 4 hours or 8 hours. You're done at 2.3 hours. If you run it for 2 hours, you get into that first interval of hour and 3, you've now depleted its water, and you've inefficiently depleted the water in the wrong hours. So I don't know if that was helpful in terms of describing at least the way we think about this analysis of both inking and decking and 1-month resources also facing shorter term constraints.
Gabe, any response? Or? Okay.
No, nothing.
Okay, thanks, Mark. And the last thing I was going to ask, so we see that this analysis is in part informing the choice of scalar.
That's right.
And a scalar that gives you that 95%, the number that you'd be comfortable with, it depends on the capacity factor, how it's operated, and this relates to some other comments we've had earlier. So perhaps you don't want to complicate this, but you can imagine that then different scalars might be appropriate for different resources based on their capacity factors, but perhaps that's not some place you want to go to try to have people file that and check that too. Can you comment?
Yeah, I think exactly like you say, it isn't necessarily someplace we want to go, maybe save those opportunity cost adders for some of that more detailed nuanced analysis on a unit-by-unit basis, but sort of keep this a little bit more general so it would be applicable for most hydro resources and it would work for most hydro resources.
I'm going to check to see if there's any last comments in the MSC or in the room on the line before we go on to the next part of the agenda.
And Ben, I think the one thing I would add here just on this particular chart is that even with that 1.35% adder or scalar, you wouldn't necessarily, it might not work for a resource that does truly only have 2.3 hours worth of storage on a daily basis. So it may not be applicable for everything. And that's one of the reasons why this specific example is the one that we showed. But just throwing that out there. Yeah. Okay.
It's overly ample for the 8-hour resource,
correct.
But you might wind up overusing the 2.3-hour resource. But again, you don't want to complicate things in terms of what people file and then to verify.
And you don't know.
This number of hours really does depend on the sort of considerations Mark was talking about.
Yep.
Okay. So at this point, thank you, Gabe. Appreciate you being up there for an hour and a half. And Elliot? Ready for your part of the presentation.
All right, good morning, everyone. My name is Elliot Nethercutt. I'm with the Market Design Policy Group, and I'm going to talk a little about economic displacement. Just as a brief review, economic displacement occurs when a resource in an import-constrained area is redispatched as a result of mitigated prices. Now, when this happens, it can lead to transfers beyond what is needed to resolve market power. Now, this is particularly problematic if a resource's default energy bid is lower than its estimated marginal costs. So we've all seen this example. I'll just briefly review it. You have BAA1 exporting to BAA2 in the mitigation run. When mitigation is applied, the market run results in lower prices of a $50 default energy bid, and that increases the transfers up to 500. Now that's our current framework, and you get a economic displacement of 200 megawatts at mitigated prices. So what we're trying to accomplish with this rule is remain pretty consistent here. In the straw proposal, we had initially introduced a rule to limit transfers to the mitigation run. Any quantity below that would essentially contradict market results. But for the revised straw proposal, we've basically expanded this rule with consideration for the base transfers. And by base transfers, I mean basically representing the bilateral schedules used to pass the hourly resource efficiency transfer test. So we've also included the sharing of flexible ramping capacity for the EIM. And finally, we've changed it so that the rule would be optional. So this would allow the appropriate entity to elect whether or not to impose BAA transfer limitations. And this application will be applied through the master file. So after our stakeholder call last week, our thinking has evolved a little bit on the formula that you see up here. I'd like to get the MSC's input here. We're sort of considering some modifications, perhaps, basically setting the export limit to the max of the base transfers and or the MPM transfers, and then adding on the flexible ramping up award. But I'll sort of pause there and see if there's any feedback.
Elliot, say that again. I want to get it in the notes. So that you're saying an alternative being contemplated now is?
Well, yeah, since the energy and the flexible ramping capacity is kind of fungible, we're debating perhaps limiting the export to either the max of the base transfers or the mitigation transfers, and then adding on the FRU up NPM award.
Ben, this is Don.
Just make sure I'm not missing something. This would, in effect, raise it. It's adding another term to this. So if that was if the base happened to be higher, then this export limit then would be higher than it would be otherwise.
So. Yeah, Ben, so it would increase. This is Don. So it would increase. So again, I think what we recognized as we discussed about this, if you look at the exports, either the base exports or the market power mitigation exports, that's the energy portion. And we would also want to include any remaining flexible ramping up that was made available in addition, because both the flexible ramping up and the energy, can be, as Elliot said, fungible. Flexible ramping is really not pure capacity. It's energy that you're going to use next interval that you could have used this interval. And so you'd want to have that trade-off when you move to the pricing run, to where you can move around both the energy and the flexible ramping awards.
Can I see the logic of having to be the sum of the base transfers and the flexible ramp? Otherwise, effectively, there'd be no ramp available over the base exports. So that makes a lot of sense to me. That's what I thought we were talking about from the beginning.
No, it's fine. Yeah, so basically the proposal is to take that term about the flexible ramp awards and move it outside of the max function and add it on. And we're also thinking of, increase a little bit the accuracy of this formula by saying, well, it's not all the flexible ramp awards that should be available for exports, but only the portion that is procured in excess of the requirements for the BAA. So we can qualify that term by adding only the positive difference of the flexible ramp procurement minus the requirement that they have to meet internally. Because the way we procure flexible ramp, you may procure more than your requirement because you're serving requirements for other areas through the EIM diversity benefit. So we're thinking of actually pinpointing a little bit.
Okay. Actually, don't you procure less ramp because of the diversity benefit, not more?
No, we're saying that because of the diversity benefit, you may procure more capacity in an area, more than is necessary to meet its own area requirements. So the remainder should be available to be exported as energy because that's how it's procured. So we can reflect that in the formula.
And what would happen in the case if balancing authority was actually importing some of its flexible capacity needs? So that quantity would be negative then? Its internal needs would be greater than what it's providing?
Yeah.
Or do you just zero that out and not consider it?
We'll just zero that out because it doesn't have an effect at this particular case. So this is relevant only if we procure more than your requirement, then this should be available for export. We should not be imposing a limit to that capacity.
I have a question on that, though, but isn't part of the diversity benefit because you can share what each entity would procure for itself? So, I mean, yeah, there's if I was on my own, if I was a BAA on my own, I might have to get 100 megawatts. Because of the diversity benefit, I only have to get 80. But that 80 that I'm getting, some of that is contributing to the diversity benefit of everybody else. So some of that 80 should actually be available to be exported, right? I mean, the reason that everybody else has to have less than their needs is because they can export, they can get some stuff from me, not over my need, but some of the stuff that I have for my need.
Yeah, I think we're saying the same thing, Steve. We're focusing only on the export direction. So if your diversity benefit is such that you only procure a portion of your requirement because you rely on imports from other BAAs, then it doesn't have an effect here. We're only focusing on what we don't want to limit out of what was procured in excess of your own requirement because it is indeed procured for flexibility for other control areas.
Okay, but what I'm saying is let's assume you have, if I can make this simple, 5 control areas. Each of them has a need for 100 megawatts of flex up. but because of the diversity benefit, the whole thing is down. You only need 400 total for everybody. That means everybody has to get 80. That doesn't mean that 80 is all they need. You know, if they still have a flexibility need of 100, which means that they're going to have to take some from outside.
Yeah.
Which, you know, but everybody else is also, you know, doing 80 exactly what they're getting. So if you say nobody has to export above 80, okay, then nobody could get over 80. Nobody could get the 100 that they actually need. They'd all be stuck at 80. There'd be no you know, you wouldn't be able to necessarily share. Everybody could be stuck at 80, and you wouldn't have that.
But at 80, then there'll be 400. I mean, it's I think that as long as all of that's available for export, I think the diversity benefit is. I'm trying to. Were you talking about the situation in which their requirement is 80, but we actually put 120 in their region?
Yes, that's the case.
So that's where they're actually, the way we schedule it, there's more than 80 in their area. Their requirement was 80, but we put 120.
Yeah. Well, okay. So
all 120.
All right. So if we set a requirement for everybody at 100, and then the diversity says, you know, so they're providing 80. If they're just providing 80, how much of that is available for this?
So the way we evaluate the diversity benefit is different when we perform the test and we actually formulate constraints in the application, the market application. When we perform the test, we're just doing an approximate allocation of the EIM diversity benefit to each BAA, and we'll go pro rata, right? So this is probably what you're thinking. Okay, so this constraints for the market application. For the market application, we're not doing any approximate allocation of the EIM diversity benefit. We actually evaluate exactly how much the EIM diversity benefit by looking how much room you have on your transfers, all right? So we take the original requirement for your BAA, and we try to meet an adjusted requirement where we subtract, for example, for upward capacity, we subtract your net import capability based on how much room you have on your transfers to import, right? So in this formula here, we're saying, fine, there is diversity benefit, and because of that, we're focusing now in the export direction, and we're saying, if we procure more than your original requirement, is because we're doing it to provide ramp flexibility for other control areas as part of the diversity benefit. So we want to make sure that when we enforce this constraint here, which is optional as Elliot mentioned, we don't want to be limiting the ability for that control area to provide that EIM diversity benefit to other control areas. So we're saying, okay, if your original requirement was 80 megawatts of flexible ramp up, and MPM procured 120 to use the same numbers that Scott was referring to, then that extra 40 megawatts, MPM procured it with the purpose of exporting flexibility from that control area to others. And then when we run the FMM, we want to make sure that we don't limit the ability for those 40 megawatts of capacity to potentially be exported. So that's as energy, yes. So that's what we're trying to do by modifying this formula. So we're on the same page. We don't want to limit the EIM diversity benefit, but we're focusing on the export direction rather than the import direction.
All right, I'll pause once more. Any other questions on the phone or, okay. So again, a very simplified example. If you put that rule into action, you would then be limiting exports to 300 megawatts, preventing economic displacement. And of course, this would assume the FRU up requirement is 0 and base transfers would be less than 300. And we could develop more complex examples based on the formula enhancements that George just mentioned.
So this is going to be optional, right? So a BAA could say, no, don't do this for me. I'm just curious, do you have a sense of, you know, most of the BAAs are likely to do this, or, you know, quite a few of them are going to opt out?
Yeah, what we're thinking, Ben, is that perhaps a BAA is comfortable with the default energy bids that have been assigned to their units, and in that situation, they wouldn't mind having additional exports under mitigated conditions. So we want to have that option available to them.
I think that's a really good idea. And Jim was asking whether the option is on the exporting, is always on the exporting side. It's not the importing says, please do that. And I realize you're not doing formal polling, but I just wondering if there was a sense from stakeholder comments or interactions that, this is something of concern to just a couple of the 6 or 7 other BAAs, or it's a pretty widespread thing, and most of them are probably going to do this most of the time.
So this is Don. I think it was about 50-50, which is why we decided we better make it optional.
Question on the phone, operator.
Caller has left the queue, so there are currently no callers in the question queue.
Okay, thank you. Caller, if it turns out that you want to, if you got cut off for some reason, please go ahead and get back in the queue. But meanwhile, we'll proceed.
Okay. So as you can see, we'll have some price separation created by this rule for those BAAs that elect to use it. So consistent with other rules, congestion rents would be accrued to the BAA where the constraint was located. So that's just a note for the implementation of the rule.
So this is broad and philosophic. Ellen's not here, but more than one stakeholder expressed some queasiness about the idea of, okay, we're going to be impacting LMPs based on a constraint imposed from market power mitigation. It's not a physical constraint. So now the LMPs mean something than what we've had in the past. And it was, I didn't see specific concerns in the stakeholder comments, that this unintended result may happen and this will be bad, but rather general queasiness. And I'm just wondering if you have any comments to address those general concerns?
Not at this point. We'll see what comes back to from the revised draft proposal.
I mean, it strikes me that we are, with contingencies and other things, adding a lot of concepts to LMPs. And I don't know if that go well beyond like what we think of as a physical thermal constraint. So I don't know.
Contingencies are in a sense a physical constraint. They're under certain circumstances. But
then, this is Don. I would just note that, the same thing would occur if the exporting balancing authority area, given the risk of this, voluntarily didn't put in the amount of transmission that limited the amount of transfers. And so I think what this is trying to do is balance that, there are these, because we'll get to there's some negatives with this as well that we need to balance with this, but, we're really trying to make sure that to the extent that a balancing authority area is concerned with this, that rather than limiting their transfers where all the time it would limit transfers, even if there isn't mitigation, that we have this backstop measure that to the extent that mitigation does trigger, it does limit the exposure you could have to being exporting at mitigated bids.
Okay, so this might, so you could say that an exporter could have the same impact by just not offering the transmission or if it's resources in the first place, but that would be less desirable. There's less flexibility in the system, and so since it's a voluntary market, this in a sense pushes. They don't have to make this decision until later. You get more in the market in the first place. Just be curious. The decision to how often could the BA decide to opt in or opt out from this? Obviously, you're not going to be doing this every 15 or 5 minutes. Could they change their mind daily, or would they have to decide, this is what we want for the next few months?
Yeah, it's supposed to be a master file setting, so it's a quasi-static parameter. So if they feel they want to change it, after a few weeks, they will be able to do it through the standard master file change process, but it's not something that is meant to be dynamically changing all the time.
Okay. Thank you, George.
Okay, so based on previous MSC comments, there were some concerns about the application of this rule, particularly if load or VER output were to change between the advisory and RTD. So in this example, you can see we have generator D setting the price at $90. And when you move into the market run, you have increasing load of 100 megawatts in BAA2. So if you had the proposed rule, you would be limiting transfers to 500 megawatts, and BAA2 would then need to rely on more expensive resources from generator F or generator D. So this does create price separation to try and limit that economic displacement. So the ISO does recognize the concern of load changing between the advisory and the RTD, and this is really not a new issue. It's just an inherent occurrence of using the advisory interval for mitigation purposes. So the potential negative impacts will probably be minimal, just given that this is in the RTD, which occurs every 5 minutes. So ultimately, with the expansion of this rule, if you include the flexible ramp up quantity as well, the importing BAA should be able to maintain sufficient resources to balance their internal load anyway. And although the exporting BAA may prefer to sell more resources even at mitigated prices, that's why we've decided to make the rule optional anyway. So with that, I'll pause for any additional feedback.
The last point, they may want to sell to get additional exports. If you're giving them the congestion revenue that would be created if they choose not to do this, and it causes a price separation, they're already essentially getting that benefit. I mean,
that's a good point.
So they're only getting that benefit on the amount that's scheduled in the advisory run. If this constraint is, there's some potential additional sales that could have occurred in the.
Yeah, but
the slide is that there's a potential additional sales that we're going.
Right, but the thing is, if they don't do those sales, then there's price separation, so there should be no.
So I think to make that point, we go back a slide. In this example, so assume that Gen C's DEB is actually $100. That's where the DEB is accurately calculating the DEB for them. In that case, they would want to sell at $100 to balance in Authority Area 2, but the fact that you restricted the transfer, they had to forego that opportunity.
That was going to be my question. So it's really the sort of definition of mitigation, I guess. Let's say that the BAA is isolated and it fails the structural mitigation test, but that the bids were all at the DEB or below the DEB, and so the mitigation doesn't actually have any consequence in terms of changing the bids themselves. Would that still be considered mitigated for purposes of the export limits?
Yes, that would cause the same limit or this rule to kick in.
Right, and so the same issues apply as if, yeah. Okay.
This is Steve Keene again. In this example, would they be getting the congestion difference on 500 megawatts between the $150 price and the $71 price?
Yeah, just up to the limit, right. And if they didn't want that limit there and they wanted to sell at their DEB, they'd go beyond the 500, right? So it actually would be.
Yeah, they'd go beyond 500, but the price would be, I don't know, I can't do the math fast enough to figure it out, but I doubt it, it might not be up at 150. It might, I don't know if they can.
So let's be clear about this. Congestion revenue collected on transfers between EIM entities, according to current rules, is divided evenly between the two parties. So it's 50% on one, 50% on the other, because it's a common constraint. On the transfer.
But not the BAA.
Yeah, no, that's not the that's on the transfer. So the formula that you saw earlier and what we proposed for that constraint is not on a specific transfer, but it's on the net transfer overall. So that encloses only the BAA. So congestion revenues on net transfer constraints, they're only returned to the BAA that has the constraint. This is a current practice with the constraint that applies when you fail the flexible ramp sufficiency test. It's a net EIM transfer constraint. Any congestion revenues because of this, they go to the same BAA that has that constraint. So the constraint that is proposed here is not on a specific transfer, is on the net transfer so that you allow well-through. And the congestion revenues for that, they're returned to the BAA that's actually hurt by it because it's an export constraint which depresses the LMPs in that BAA, right? So I know you mentioned earlier something about benefits. You were saying as receiving the congestion rents as a benefit, but you have to see that this is really the money that you're losing because your LMPs are depressed because of the export constraint. So I wouldn't consider it a benefit.
All right. I was going to say, I think it might be helpful if you could take this example and look at the two different situations. What happens if they choose to increase it, or if they say, no, we're not going to, and then they get the CRR revenues, and just to see what it would be.
You mean the congestion revenue?
Yeah.
Yeah, I guess we can work this out.
This is Mike Hespelano from DMM. So, George, in that example, I think what happens here is the role of the net export constraint changes significantly. I think in this example, you wouldn't have a binding shadow price necessarily on anything between the two BAAs. It would all be on the net export constraint, right? Because that's where you're imposing this limitation.
Yeah, so as I said, the constraint is a net EIM transfer constraint. So the shadow price of that constraint goes directly into the LMPs for that BAA. You remember the decomposition of the LMP for the BAA?
Yeah, but I'm not sure that I agree with you entirely on that.
Oh, because, okay,
I think we're talking about the decomposition of the LMP for the BAA, and then there's the congestion rents. I mean, I think we're getting, the price will be depressed and increased in the receiving and sending BAA based on the decomposition of prices.
Right.
We're asking is the congestion rents that are collected because of those.
Right. And so if the congestion rent, as it should, goes to where the shadow price goes, I think in this case there probably won't be a shadow price on the ETSR or any transfer in between the two. The shadow price will fall onto that net export constraint.
Yeah, that's what I said. This is a simplistic example, so it shows the constraint transfer between BAA1 and BAA2. In reality, the constraint will be enforced on the net transfer of BAA1. Okay?
Okay, I look forward to your examples.
All right.
Just make sure I understand the net transfer in this case being 100. 500 minus 400.
Yes, that will be 100 export.
Yeah, so if it turned out in this run that, well, it can't go above 400, but let's say from the left it dropped to 350, then on the right between BAA1 and 2, that would have to fall to 450 if you constrained 100.
It's possible if the original constraint that caused the mitigation is relaxed in the next run, then that is possible.
Okay. I think we might be done. Let me just last check on the phone lines.
I'm not showing any questions at this time.
Okay, thank you. Okay. Ellie and Gabe, thank you both very much. for the long session, and we're finishing miraculously just about on time. So at this point, Operator, we're going to be breaking for lunch, and we will reconvene at 1 p.m.
All right.
So at this point, everybody have a nice lunch, and we'll see you in an hour.